Welcome back to the Deal Flow Podcast. I'm Michael, and we're here today with Alan Lomax, and we're going to talk a little bit about private placements, LP investing, the current environment, and all things diversifying your income and your wealth away from Wall Street. And so with that, Alan, I'd love it if you could just give us just a rundown of yourself and your background, and then we'll jump into some questions.
Well, thank you, Michael. Thank you for the invitation to be on the Deal Flow podcast. It's a real privilege to be with you and your audience. Well, so just recently, I had an experience with a horse, and his name is Finn. And this experience really kind of clarifies something really important for me, and that reveals a lot about my life journey as well as my investment journey. But Finn had been a show horse for really all of his life, and he was when he came to my friend, he had been just recently retired, and he was in his 20s. He probably should have been retired 5 years ago. But anyway, my friend acquired this horse, and at any rate, sometime before they retired him, I don't know, 3 or 4 or 5 months before they actually retired him, he had suffered an injury. But instead of allowing him to heal, they just continued to show him and drugged him up so he could deal with the pain. And so that's unfortunately not an unusual thing that happens in the horse world. Finn did like what all other horses do. He complied, not because he was thriving, not because he was healthy, but because compliance was just the safer and less resistant path. And so that experience really struck me because in many ways, I think we often do the same thing. We go along with expectations, we follow the prescribed path, we pursue careers that look successful, and we follow traditional investment advice. And often we don't even realize that we're doing it. Our conditioning is so unconscious and so subconscious that we never realize how we are conditioned. So we're not necessarily making conscious decisions. We're making decisions based on all of that formal conditioning that we never even had a say in how we were conditioned. And so that realization led me to something now that I see repeated many of us. We just move through various different stages from conditioning to alignment and finally to freedom. And over time, I began thinking about this as really a 3-step process. And so what that 3-step process really is going from just blind conditioning to really becoming aware of what it is that our basic values are and what it is in life that brings us value. And then that leads us really to that process of being able to really thrive. So that 3-step process is recognizing, that's waking up. And number 2 is redefining what it is that brings us meaning. And then the 3rd step is really moving towards thriving in not just investing, but in all areas of life. So it becomes a naturally flowing process that really begins to build multiple streams of well-being. So we move from surviving to thriving. So I didn't do this consciously. I moved through several of these steps myself. So just about where I came from, I started out in investing with not a whole lot of knowledge, just kind of going by the seat of my pants. And I got into real estate and was doing really from in those days, there wasn't a name for it, but I was purchasing properties and then renovating them and getting tenants in there and then refinancing and kind of moving on and holding those properties. And that worked really well until it didn't. And that time that it didn't was 2008 when everything crashed. Students couldn't pay their rent. I couldn't pay the mortgages. And so I lost really essentially almost everything in that 2008 crash. So I was just conditioned to follow those traditional paths. It and was okay until it wasn't. And when it wasn't, then I had to do a whole lot of personal reflection and really look to see who I was, what I was, because not only did my investments crash at that time, I also lost a job in a profession that I found a great deal of fulfillment and satisfaction. And so, in that process of reflection, I started really getting educated, and I began to realize that single family investing can be good, but there's a lot of risk in that people just don't realize. And so I started looking towards commercial real estate, particularly multifamily, and the idea was that I was going to go into multifamily investing myself. And so I started looking into that, looking at properties and started assessing properties. But I also, during that process, began to realize that there are sponsors out there who are much more experienced than I am, that have the background, that have the capital, that have their act together. And so it dawned on me that why am I building from scratch when I can start working with established operators? And what do established operators always need? They always need more capital. And so I started approaching sponsors to work with them on capital raising because I had already started building a network. And so I had individuals that I could bring to deals. And so that's how I got reestablished. How I started reestablishing my wealth was actually working with other sponsors. So that's a bit of my story. So
Yeah, so that's great. Thanks. And I think what's unique about your journey is, or rather where you are today, is that you sit between the limited partners and the general partners. And so you get to see both worlds, right? A lot of times people, if you're on the GP side, you don't get to see that LP side. If you're on the LP side, you don't get to see the inside. And so being someone who gets to, vet operators, pick the ones that you find have the best opportunity set, best, and then I'd love to go through that with you on how you guys think about operator selection. And then I also want to talk about LPs. What are LPs thinking about today, and what's their concerns? What are they trying to achieve? But let's start with maybe the GP side, so the sponsor side. Maybe talk a little bit about, in the beginning, when you were coming out of that financial crisis, a lot of ways you could throw a rock at any piece of real estate and you could have made money just on price. It's a little bit of a different story today. Prices have moved up quite a bit, and obviously the interest rate environment and the expense environment has changed dramatically since the mid 2010s. But maybe talk a little bit about the early days of evaluating operators, and then how that's maybe evolved through today, and how you think about working with your sponsor groups and bringing those opportunities to your investors who obviously trust you with their capital.
Well, yeah, that has evolved considerably over time. And initially, the sponsors I was working with were sponsors that I had connections with, and I wouldn't say that I was doing a great deal of due diligence on those. I knew them from my own networks, and so was working with them and trusted them. But today, the due diligence process is much more extensive, and what we look for is we look for operators with a track record. Having been through 2008, I definitely want to work with people who know what they're doing, because even in 2008, the real estate investors who made it through that were experienced investors that knew what they were doing and positioned themselves from the get-go so that they would be ready for recessions or depressions or wars or whatever it is that comes along. They position themselves in a way that they can sustain through whatever is going on. So track record is one of the most important things that we look for. And then we look at the companies themselves. How are they structured? Do they have a well-structured operation from the top to the bottom? Are they vertically aligned? I mean, it isn't that we're always going to work with vertically aligned operators, but that's always a good thing to see. We know that they're a good, solid operator. And also, when they are vertically aligned, they have much more control over the entire process. If they're contracting out, they're much more susceptible to market shifts than those who have everything vertically aligned. And then, of course, after we have looked at the sponsor, then, of course, we look at the individual deal and see if the deal is providing the returns that we expect for our investors there. So that's just kind of an overview. If you have specific questions on that,
Yeah,
certainly address that.
I think maybe one more question on the GP side or the sponsor side. I know you mentioned, you're looking for vertical integration, you're looking for experience and track record through multiple cycles, presumably. And then, obviously you're looking at the product, right? Is this, within that context, is this opportunity good enough to clear the market? Does it have the downside protection, all the things? The other, especially, I guess it's a little bit different now maybe than it was before interest rates changed, but maybe are there any specific market clearing returns or metrics that you're looking for that are, when you think about the deal, right? Because there's developing the experience and the vertical integration that takes time, years, decades of time, right? But deals come every day, right? So that same operator could bring 5 different deals with totally different profiles, and some of them may not be a good fit, some of them may. So at the deal level, what are the non-negotiables? Like, do you have non-negotiables on location or cash flow or return, total return? Like, what does that look like? And the second part of that would be, has that changed dramatically now versus pre-2022, Fed increase in rates, right? So that, I call that kind of the market sort of changed at that time. So before then to now, how has that change, and what are those non-negotiables at the deal level?
Yeah, that's a good question. And really outside of the deal, of course, the deal sets within that, and that is location.
Mm-hmm.
And so we're looking at the growth areas in terms of population growth, income growth, employer growth. All 3 of those metrics are always very important. And so with those in place, then of course we're looking at the individual deals. And, in terms of just the metrics, we're looking for internal rates of return of 18%, equity multipliers of at least 2. It is, from 2019 through 2022, those were easy to come by. Today, those kind of metrics are challenging. So if operators are finding deals that work within those parameters, that is, that in and of itself tells us that they are a pretty well established operator, because those opportunities are not falling from the trees, that's for sure.
Mm-hmm.
In fact, the operators that we work with are probably looking at anywhere from 100 to 300 deals almost on a monthly basis
Mm-hmm.
to come up with perhaps one that they're interested in investing in. And oftentimes the deals are in some respects coming to them because they are so established that sellers aren't even going to the market.
Mm-hmm.
They're often going to sponsors that have a good reputation, and they know that they're going to get the best deal that they're going to get from these investors. Recently, one that just closed was kind of that same scenario. The reason the sellers sold to our sponsor is because they had a time frame in which they had to close, and they knew that the sponsor could do that in the time frame that they had to work with, and they were willing to take the offer that the sponsor gave in order to make that timeline. So those kind of things make these kind of deals possible.
Yeah. And I think that also goes to the environment that we're in right now, right? Like the number of deals that are trading, in 2021, or you just, you would clear the market at the top, price, right? If everyone was selling because it was a great time to realize returns and get that high IRR, that maybe not necessarily always the MOIC, because, people were buying and selling very quickly, but they were realizing really strong IRRs, which they could then use to raise more capital and realize promotes. and whatnot. Now, opportunity set is fewer and farther between, and each deal that is an opportunity you got to work for. So far as the actual execution, right? It's not like you're just buying a 95% occupied property and just magically going to change the rents in Yardy, and then all of a sudden people are going to pay it for a technology package made of a Ring camera and a Nest thermostat. That doesn't fly anymore. So it's definitely become harder out there. But I think that's not necessarily a bad thing. It's a more normal environment, I think.
Yeah, I think it's much more normal, and I think it separates the good operators from the bad.
Mm-hmm. Yeah, for sure. And now let's go on to the LP side, just because I don't have forever with you, and I want to hear what the mindset of the LP today. And I'll start it off by just saying, we work with some folks that raise capital, and what they've told me is that the appetite for deployment in their universe, when they're having conversations, is down about 70% versus where it was in the peak, right? Like all thing, this is a broad stroke sort of thing. It's sort of, sentiment related, capital flows related. But if they were raising $10 million a pop before, maybe they're raising 3 to 5 now, or whatever the exact numbers are. It's down considerably. I wonder what you think. Is that consistent with what you're seeing? And if so, why are LPs hesitant maybe to put dollars to work today at arguably, some of the lowest prices that we've seen in a decade and a half?
Well, we work with a lot of high income earners, and going back to talking about conditioning and really realizing that conditioning, the high income earners that we work with, we have an extensive educational program, and the reason we have this extensive educational program is because what you just mentioned there is the hesitancy. Well, our high income earners have been conditioned to really rely upon public markets. The people that we initially work with, essentially they have anywhere from 90 to 95% of their portfolios are in the public market through 401ks, RAs, then in various other stocks, bonds, and mutual funds. Well, they've been conditioned to think that that is where investments should go. And our job is to actually essentially wake them up and say there are better alternatives. In the United States, there's approximately 13 million or so accredited investors. Out of that pool of some 13 million accredited investors, only about 5% of them ever cross over from those public markets to private placement and private investments. And yet, when we look at where the wealthy of wealthiest are investing, it is just the opposite. The wealthy are putting their capital into private placements. So why is it that only 5% of accredited investors are crossing over that, essentially this barrier that keeps them from doing that? Well, one is that they just aren't conscious of the fact that there are other better investments out there. And the other is it's new and it's different. And all of their advisors have been telling them to follow the traditional path and keep it all in there. And so that's why we strongly emphasize education, because not only are there better opportunities in the private placement sector, but from my perspective, it's a much more stable environment. It is, you can project with much more assurance, and there's no absolute in any investment world, but you can make your projections much better on stable, solid, tangible assets than you can upon the public market. So once our investors that we work with see the light of day, then we don't have any problem in bringing them investments. They're going, yeah, bring those to us. We're looking for those. That's what we want to do. And they do start transferring their assets from the public into the private investment portfolios and really start balancing out their portfolios. But yeah, there's tremendous resistance until they've actually had the opportunity to go through an educational process and actually see the benefits of the private placement side of that.
Yeah. I think one of the or two things that are, kind of uphill battles a little bit, is that public equities have performed exceptionally well these last 5 years, much better than they should, historically speaking. And usually when equities outperform themselves, it means that they're going to be underperforming themselves in the future. But that's not really how we humans look at it. And if we see that our trailing 5-year returns for the S&P 500, which was simple and I didn't have to do anything, was 15, 20%. And then private placements have, with rising interest rates, have struggled. That's the exact time when you want to be deploying into the underperforming asset and taking money out of the outperforming asset, right? But that's psychologically very difficult for people to do, like you mentioned. And then I think beyond that, there's also just a lot less opportunities out there right now in the private placement world because there's not as much liquidity as there was. So people aren't exiting deals. They're not entering deals. No one who owns a deal who doesn't have to sell is selling. But I think that makes the opportunities that do come up that more valuable. And to your point, 18% returns projected for a private placement is, and with all the tax advantages and the current cash is very attractive. And, I don't think there's been really a 10-year term on the S&P where you've been able to achieve that type of return. Certainly not 2 times in a row, not 2 10-year periods in a row. We have seen it happen here once, but not really ever before. So when, what are the most important factors that your investors are concerned about? Like, what are they, I'm sure it's very similar to listeners, right? But maybe just hammer home a little bit. What are these investors looking for ultimately, and why they end up deciding to move forward with this, either taking earnings and deploying them or selling off something else as an alternative and saying, hey, I don't want IBM stock anymore or whatever, and make a conscious decision. I'm going to allocate away from this and into that. What are they hoping to pick up from that decision?
Well, one of the big selling points is the tax liability reduction that private placements bring individuals that you just are not going to find in the public markets. So that in terms of the returns are, generally speaking, going to be much better than what they find in the public markets. So once they see these two things together, that is what we see is really the deciding factors for them. Their hesitancies are that they've just been conditioned to think that the public markets are safer than the private markets. And so that is always a challenge to develop sufficient trust to be able to trust a private market. It seems a bit counterintuitive to me. I have never been one to trust public markets myself. So it's like, what is it about private markets that you don't trust? Well, I think the private aspect of that, some of the terminology, syndications, what do we think of syndications, the mafia, and so on and so forth? And we think of Ponzi schemes and all of those different things. Certainly, those are possible in the public markets, but they're also very possible in the public markets as well. So when they understand really that private markets are regulated by the Securities and Exchange Commission, that not only are they regulated by that, but there's a tangible asset that this investment is tied to. Bringing those things forward and really looking at the documents, the legal documents that underline all these investments. You don't just go out and here's $50,000, do what you want to with it. There are private placement memorandums, there's operating agreements, there's subscription agreements. All of those are legal documents that are part of that whole entire process. And once they see that there really is a solid foundation, then that trust increases and they're able to really make that shift and go, yeah, I can trust this, therefore I can take advantage of the tax liability reduction processes and take advantage of the higher returns that are part of this whole entire process.
Mm-hmm. Yeah. And, you know, I would be remiss if I didn't go an hour talking about AI these days. And so, I wonder if, LPs, especially these high income earners that are relying principally on their skilled labor, have concerns around the durability of that income, either because of AI or just because, hey, I've been a doctor for 20 years. I don't want to deal with the insurance companies anymore and reimbursements and running my office staff and everything. And just, I need something on the other side of that. And it needs to be quite a big number if I'm trying to replace a doctor's salary or expenses and things like that. Do you find a lot of people talking about that as this is it a diversifier that they're going after? Or are they looking for a replacement to exit, what they're currently doing? Like, do you find you're getting in touch with people early career, or are you finding people mid to late career who are saying, oh no, I have not done the work I should have done to create the future, to help the future me that isn't going to be a doctor or a lawyer or whatever? What's the typical person that you're dealing with, or that the mindset?
Well, it runs the gamut really, but I would say probably the majority are midterm to late in their careers. And, I think that probably all of us have this concern of, I was in a profession I loved and even while I was in that profession, there was always this thing in the back of my mind, well, what would happen if suddenly this income isn't here? Which it could be for a number of reasons, like I lost that job, but people become ill and they can't continue on, or other family members become ill, and there's all kinds of reasons that job can suddenly be taken away, and I think all of us have that in the back of our mind at all the time. So we should always be building for something that can take the place of that. Plus the fact, if you don't want to work for your money your entire life, and if you're working for your money, you're never going to develop wealth. The only way you're going to develop wealth is when your money starts working for you rather than you working for your money. And in terms of the timetable, if many of the people that we're working with have already developed 200,000 in 200 million, not 200 million, but 2 million in terms of their investable capital. And when you reach that $2 million level, which many high income earners have already attained, it's time to start putting your money to work. And if you've got a foundation of about 2 million, we can easily help you attain that financial freedom where you can decide whether you want to continue practicing or whether you want to put your money to work for you. You can do that probably within a 5-year time period if you already have that $2 million foundation. If you don't have that $2 million foundation, depends on what your income is and how you're going to start allocating that income, rather than putting your income towards lifestyle inflation, or whether you're going to put that income to work to really start building a good foundation. With a good income, you should be able to have financial freedom within a 10-year period of time, no matter where you're
starting from, right? Yeah. So I think those are good yardsticks, right? So if you have that capital base already, and then 5 years is achievable, and then if you don't, but you have a good strong income, and you make the right decisions and you're disciplined, and a 10-year period will get it done. And that, I think that gives hope to a lot of people that maybe feel like they need a 40-year time frame, because that's the conventional wisdom, right? Is that, hey, you're going to start at your first job, you're going to put money into it for 40 years and close your eyes and hope that there'll be enough at the end, and you'll have enough money for the rest of the time.
Yeah.
So yeah, that makes a lot of sense. And I think for a lot of people, hopefully that's relieving, right? That it's not, you don't need that whole 40 years to do that. You only need that because not to be against Wall Street or anything like that, but they want you to keep that money in there for 40 years because they make fees on it every single year, right? And I think if you do the math, which I have, and I'm sure you've done as well, it's sickening the amount of money that you pay in fees, even if it's just 1% a year or even 50 basis points a year. And there's all these other fees that you don't see at the fund level that never show up on the expenses. And it's millions, especially for high income earners that have gone to, pay for fancy offices and, Porsches and for the bankers. So, it can, even though it seems like a very small amount, it's not over the long term.
Yeah, it's quite significant. Yeah, and it compounds.
Yeah.
So
Yeah. It's money that, it's a phantom loss that you never see, and then you can't compound on those dollars. And there's a compounding effect to it. So let's talk a little bit now about the market. So we talked about on the LP side, we talked about the GP, the deals, the structuring, a little bit about the mindset of the people that you serve. And it sounds like you come at it from an education perspective, which means you're probably keeping a pretty good pulse on what's going on and where the puck is going. And so when we look at, it's 2020, it's April of 2026. And, I'm asking you to take out your crystal ball here a little bit and say, as we go through the rest of the 2020s and we think about, your chosen asset class, where's the opportunity? Where are you? It's not, because it's not, just finding deals, the geographies change, the migration patterns change, thesis has changed sometimes. Like, where do you think over the next few years people should be thinking about that? That might be different than maybe before. Anything's changed or anything you want to reinforce around where you think the opportunity set is right now?
well, there's just a tremendous amount of uncertainty, and who knows what is going to happen. The United States financial system has been extraordinarily resilient for over the last 75 to 100 years or so. It's been a reliable place to put one's money. So the United States has resilience. It, in a lot of respects, more than it seems that it should have. But it keeps on going. Historically, nations who have faced the debt problem, like the United States is in right now, they start to crumble and decline. It should be happening in the United States, and frankly, it isn't. And it just keeps on going. There is something about the United States that has a resilience that logically it shouldn't be having. Of course, the reason that we can carry this huge amount of debt is because we're not paying for the debt. We outsource that debt through the dollar payment system, particularly the petrodollar. Well, that system is in jeopardy, and people look at Iran and they go, that's really all about oil. Actually, that's all about the dollar. The United States doesn't care if Iran sells oil. They care about the fact that they're selling it in China yen rather than in the dollar. That's what really matters. And the same thing with Iraq. That's what the invasion of Iraq was all about, was the dollar. That's what was going on in Venezuela. Venezuela's exchanging oil and the Chinese yuan. So the dollar is under threat. But what is that going to mean? It's hard to really tell because the dollar is still very resilient, even though it's under attack. I don't know where it's going. But in terms of answering your question, what am I going to do for the future? I'm going to keep my investments in solid assets. Historically, the Federal Reserve Bank of San Francisco did a 150-year longitudinal study looking at across 16 economies and looking at all investments over those 150 years through recessions, depressions, inflation, currency devaluations, wars, and so on and so forth. And it was the solid assets that outperformed over that span of time. And I think that going forward, it's going to be the very same. The solid assets, why do they perform throughout all of those different things? Well, people need them. People are going to need a place to live. People are going to need energy, and so we're investing in energy. Our need these hard assets. So there is always, and not only, the hard assets are also going to be not only a solid foundation, but they're also producing an income because people need those place to live, they need the services, they need what those hard assets have to offer there.
Yeah. Yeah, and right. So hard assets, in an environment, if the view is the value of the currency is going to go down, right, then you want to be in hard assets because you're buying in today's dollars, and those dollars are the price, the nominal price is going to keep going up. And the benefit of real estate is that we buy with a lot of debt, hopefully fixed debt. And if you use fixed debt, that inflates away over time, right? That, and not right away, but over decades and generations. And I know this because every piece of real estate I've ever sold seemed expensive when I sold it and seemed like a good idea at the time. But now looking back, I'm like, wow, I wish I would have kept that thing at half the value it's at right now. And so I think there's a lot and then of course you talked about current income, the rents typically will increase with inflation. And as a consequence, the cash flow usually will, over time trend with nominal growth as well, which means you can be protected on that stream of income. So I'm right there with you. I love the hard asset. No one's gonna AI themselves out of a place to live, right? So I feel like we've got some amount of time before everyone uploads themselves into servers, and then maybe we have to be concerned. But I think we've got some time before then, and housing should continue to be a durable necessity that everyone needs. Yeah. So I guess if we were to say, if someone was because we're coming up against the end of our session here, if someone was, a high income earner, mid-career, they just spent the last 15 years going to school, finally finishing maybe their residency, doing their specialty, getting started. They're now finally making a good income. They're working 80 hours a week, but they're making a good income. What would be that golden nugget that you would leave them with, or what's that first step that they should take? Because like you said, probably all they're doing right now is throwing money into that 401k, right? That's all they're doing, and they're making a good income. And now what? Now they're starting to think about their future. What's that golden nugget?
Well, those 3 steps: wake up, realize how you've been conditioned to just follow that formula. And many high income earners, just like you laid it out there, they've spent years in school, gone through residency, they've followed the game plan. Wake up and realize that you need to take a look at what are your values, what do you want to do for your own well-being, and what is your purpose in life. And with that, start taking the steps so that you can thrive not only financially, but in all areas of your life. And if you're interested, we have a free gift for your listeners, and it is just a mini masterclass, and we call it Beyond the Paycheck. And you can find this is a long URL. It's at www.go.steedtalker.com/beyond-paycheck. And you could also find us just at our website, which is Steed Talker.
Thank you so much for that gift. We're also, because it's a long URL, we are going to put that in the show notes for everyone. So make sure that if you're driving, don't feel like you have to write that down. We're going to get that in the show notes for you, whether you're watching this on YouTube or Spotify or one of the other 75,000 other platforms that syndicate out these podcasts. So with that, Alan, I want to thank you so much for sharing your perspective on what LPs and GPs are doing today, what they're thinking about, how high income professionals can diversify away from Wall Street. And that predicates on a mindset shift away from the traditional and maybe onto a little bit of the contrarian. So appreciate that perspective. Thank you. And we'll see you next time on the Deal Flow podcast. Have a great rest of your day.
Thank you, Michael. It's been a real pleasure.